Welcome to the Deep Dive. We're here to unpack some really fascinating ideas for you. And today, we're kicking things off with something I think, well, pretty much everyone can relate to. You know that saying, growing up is optional, but growing old is mandatory.
Ah, yes. Hits close to home, doesn't it?
It really does. It captures that universal truth about aging, right? How our capabilities change, our perspective shifts. The whole thing, as the years pile up, you inevitably feel it.
Absolute.
For me, I definitely get that sense sometimes. More years behind than ahead, even being optimistic. And it's a mix, isn't it? There are definite pluses. Maybe less pressure financially or with work.
Oh.
More time, perhaps.
A bit more freedom, maybe some accumulated wisdom about what actually matters.
Exactly. But then there are the minuses, those little reminders, things you did easily 10, maybe 20 years ago. They take a bit more effort now. Or maybe they're just off the table. It's just life evolving.
It's that constant recalibration.
Right. So I want you listening to just take a second and think about your own journey with time, your own pluses and minuses. Because today, we're taking that exact idea, that human aging concept, and applying it somewhere else.
To the corporate world.
Precisely, to the corporate life cycle, because companies age too, just like us. And what's really fascinating and often leads to big successes or spectacular failures is how hard they fight it.
Oh, constantly. They're always looking for that corporate fountain of youth.
Totally. Trying to be young again, maybe through big splashy acquisitions, trying to buy some youthful energy, or hiring armies of consultants for a kind of corporate facelift.
Trying to look cutting edge, even if the core business is getting on a bit, yeah.
So our mission in this deep dive is to unpack this whole corporate life cycle idea. We think it's like maybe a holy grail framework, not magic, but a powerful way to understand almost everything in business.
Connects so many dots.
Exactly. Corporate finance, valuation, investing strategies, even managing people. It all ties back. And we're drawing heavily from the work of a real expert here, Aswath Damodaran, specifically his insights on the corporate life cycle from his YouTube channel.
And what's truly fascinating, as you said, is just how universally applicable this is. It's not just a nice metaphor. It really is a practical, predictive framework that touches, well, every single part of a business's journey.
From day one, right, from the initial idea.
All the way to decline, and sometimes maybe a rebirth. It lets you see why companies do what they do, anticipate challenges, opportunities.
Yeah.
It cuts through a lot of the noise.
I love that. Cuts through the noise. Okay, so let's dive right into the stages. That direct parallel company as human, it's almost uncanny.
It really is.
So a startup, the source describes it perfectly, like a baby. Just starting out. Tons of potential, possibilities seem endless, but it's also fragile, dependent.
Completely reliant on outside support, yeah.
Yeah.
Like that classic tech company in a garage fueled by coffee and dreams.
Right. Great idea, maybe, but no revenue, no real product yet. Survival hangs by a thread. It's all about the founder's vision and finding someone to believe, to invest.
Nurturing that initial spark.
Then you get the very young company. This is the toddler stage. Lots of learning, uncertain steps.
And falling down. A lot of falling down.
Yes. They stumble, pick themselves up. Sometimes really struggle after a setback, like a failed product launch. It's all trial and error, finding their feet, figuring out that product market fit.
Often chaotic, but full of energy. Exploring.
Then comes the high-growth company. This is the teenager. Immense potential, boundless energy, feels like anything's possible, right? Rapid expansion, maybe groundbreaking tech.
But just like a teenager, also very capable of, as the source puts it, screwing up their potential.
Yes. Rash decisions, maybe getting overconfident after early wins, stretching too thin.
Yeah, strategic missteps. They have momentum, but also this huge capacity for self-sabotage if they're not careful.
Then, as things settle, you get the mature company, like reaching middle age. They've found their limits, mostly, settled into who they are. That explosive growth, probably behind them.
The focus shifts. It's more about refining, optimizing consistency. Think of a big, established car maker or a major consumer brand.
And finally, well, the stage of decline and death. Sounds grim, but it's natural, isn't it? An inevitable part of the cycle for many companies that just don't adapt.
It is. And that mapping, that simple analogy, is why the framework is so useful. It's predictive. Knowing the stage tells you what challenges to expect, what opportunities they might chase, even the mistakes they're prone to.
Like seeing a company acting like a teenager and thinking, okay, maybe watch out for that impulsive acquisition.
Exactly. or seeing maturity and expecting a focus on efficiency, maybe dividends. It gives you a baseline understanding across any industry. It helps you see the underlying dynamics.
That predictive power is key. But there's a big caveat here, right? Not all companies go through this at the same speed. The pace varies wildly.
Hugely. The source gives some great examples.
Like GE, General Electric, a giant for over a century. Took about 130 years, roughly, from birth to, well, its major transformation and downsizing, a very long, slow cycle.
A marathon, definitely, spread across so many different businesses, each maybe moving at its own pace.
Then you look at Yahoo, an internet pioneer. Went through a similar full-cycle birth, massive growth, maturity, decline, acquisition in maybe 25 years.
A sprint compared to GE. It's a staggering difference.
So what causes that? What speeds things up or slows them down?
Well, forces that accelerate the climb often involve things like really disruptive innovation, something that just shakes up an industry, lets a company grab market share fast.
Like the iPhone did for mobile.
Precisely. Or maybe a strong first-mover advantage that locks things up quickly. That can propel a company through the early stages super fast.
And what about slowing things down or keeping a company at the top longer?
That often comes down to building strong defenses, those deep moats. Sustainable competitive advantages. Could be incredible brand loyalty, like Coke.
Or powerful network effects, where more users make it better for everyone, like Facebook early on.
Exactly. Or maybe continuous innovation combined with huge scale that just makes it tough for anyone new to compete. And then some things can make the decline more gradual too.
Like what?
Maybe a really loyal customer base that sticks around. Or long-term contracts providing revenue. Or valuable assets you can sell off slowly, allowing for a more controlled wind down instead of a sudden collapse.
That makes sense. And the source mentioned that 21st century companies often have much more compressed cycles.
Oh, absolutely critical point. That compression is huge. Technology changes faster, markets are more volatile, competition is global, information flows instantly. It all forces companies to evolve or decline much, much quicker than, say, 100 years ago.
So the windows of opportunity are shorter, the need to adapt is way more urgent.
It's a much higher stakes game today. Complacency gets punished fast.
It's a stark difference. So if you're watching a company, understanding its likely pace, is it a rocket or an ocean liner? That's fundamental. It changes everything about how you see its potential and its risks.
Absolutely.
And once you know the stage, it totally changes how you look at their finances. How a company handles its money, its financial priorities, they shift dramatically with age.
The basic principles, investing, financing, dividends, they don't change. But where the emphasis lies, that's the key shift.
Like shifting gears in a car. Different stages require different focus.
You got it. And grasping that shift is vital for good management and definitely for smart investing. It dictates where the money comes from, where it goes, how value gets created and returned. Ignoring it, often a recipe for trouble.
Okay, let's break down those priorities by stage. For young company startups, early growth, it's almost all about investing.
Almost entirely. They have little or no revenue, no market share yet. Everything is about growth.
So capital expenditure, building things, R&D, marketing, sales, hiring talent, every dollar goes into fueling that growth engine.
Correct. Think of a new tech startup burning cash like crazy. They're not trying to make a profit now. They're investing to build the product, get users, dominate a future market. Profitability might be years off.
Sometimes intentionally deferred, even just to grab that market share first.
That's often the strategy. Invest everything in growth.
Okay. Then they become mature companies, middle-aged.
What?
What's the financial focus then?
It shifts. It moves much more towards financing decisions. They have established operations, market share is stable-ish, growth is slower. So the game becomes optimizing their capital structure.
Meaning?
How do they manage their debt? How do they use equity efficiently? What's the best mix of debt and equity to fund their steady operations and maybe some moderate future growth?
Right. So less about finding money to grow aggressively, more about managing the money they have or need for incremental things.
Precisely. Think of an established manufacturing company. They might be looking at issuing bonds versus shares to upgrade a factory. It's about efficiency, managing risk, funding stable operations, and sustainable, slower growth.
Cost effectiveness becomes more important.
Very much so. How to fund things in the least risky, most efficient way.
And then the declining stage. What happens financially?
The emphasis swings again, this time strongly towards dividend decisions, returning cash to the owners.
Because growth prospects are dim.
Or negative. The market might be shrinking. So reinvesting doesn't make sense. The priority becomes extracting value from what's left, scaling down, maybe selling assets.
And giving the cash back to shareholders through dividends or buybacks.
Exactly. Think of an old newspaper publisher paying out big dividends. There are no good growth options left, so they return the cash generated from the declining business to the owners. Reinvesting would be throwing good money after bad.
It's so logical when you lay it out like that. The principles are the same, but the focus reflects the reality of their stage. And the problems start when they don't act their age.
That's usually where the big mistakes happen, when they fight the cycle.
Like a young company borrowing way too much, too early, before they have stable cash flow.
Yep. Over-leveraging leads to bankruptcy or fire sales. Or a mature company trying to recapture explosive growth through, say, crazy, unrelated acquisitions.
Right. Overextending, going into areas they don't understand, taking on too much risk for their stage, destroys value instead of creating it.
You see it happen. They run into the limits of what they're trying to do because it's out of sync with their life cycle stage.
So this leads to a really practical question for you listening. Look at the companies you follow, invest in, maybe work for. Are their financial choices appropriate for their age, or are they fighting the cycle?
That question alone can tell you a huge amount about their prospects.
Yeah, absolutely. And that ties directly into valuation, figuring out what a company is actually worth. This can seem super complex, all models and numbers,
It can be intimidating.
but this framework helps simplify the core challenges. The basic idea value comes from future cash flows and risk that stays the same. But the challenges in applying that, the uncertainties, what you actually focus on, that changes dramatically depending on the stage.
Precisely. Valuation, as the source puts it, is like a bridge between stories and numbers. And that balance, story versus numbers, it shifts massively.
Wow.
Early on, you're buying the dream, the narrative. Later on, you're buying the machine, proven by the financials.
Okay, let's unpack that. Early life cycle startups, young companies. Value is driven by.
Overwhelmingly, the story. They often have minimal revenue, no profits, so you're valuing the potential. The market disruption idea, the team, the vision.
It's about belief in the narrative. How big could this be?
Exactly. Venture capitalists spend their time assessing that story, the market size, the team's ability, not crunching historical P&Ls, because there aren't any.
A challenge being massive uncertainty, limited data, lots of assumptions.
Huge uncertainty. Valuing a hot new app with users but no revenue. It's all about believing the story of future monetization, network effects. The numbers are mostly optimistic projections. Qualitative factors dominate.
Okay. Then things shift for mature companies. Now the driver becomes
The numbers. These companies have financials, earnings history, market position. Valuation is based on performance you can measure, cash flows, balance sheets.
So analysts use DCF models, compare multiples to peers. It's much more quantitative.
Right. Predictability, stability, efficiency, that's what you're valuing. The challenge isn't proving potential anymore. It's demonstrating consistent profitability and returns. The explosive growth potential is usually lower.
And for declining companies, what drives the value then?
Often, it boils down to asset value, liquidation value, what can you sell off, intellectual property, real estate, equipment, customer lists.
So less about future earnings, more about salvage value.
Pretty much. The challenges are huge negative cash flows, shrinking markets, uncertainty about whether they'll restructure or just shut down. Valuation is about managing the decline, minimizing losses.
So thinking about this, when you value a company, you need to ask, am I focusing on the story or the numbers? And is that appropriate for where it is in its life cycle?
That's the crucial diagnostic question. It clarifies why different investors focus